trading puzzle resolved. Volatility 100 trading puzzle resolved. How to enter on the correct bias for trading volatility 100 index. Using the third candle rule, once you have identified your 24th candle marked with both vertical and horizontal line for its average price, the third candle that opens afterwards is your bias formulation candle. To form a bias, you need to look at 6 dynamic ways the third candle could help you form a bias, namely 1. Bearish closing while opening bearish below the average price of the 24th candle. 2. Bullish closing while opening bullish above the average price of the 24th candle. 3. Bullish opening with bearish closing below the average price of the 24th candle. 4. Bearish opening with bullish closing above the average price of the 24th candle. 5. Bearish opening with bullish closing below the average price of the 24th candle. 6. Bullish opening with bearish closing above the average price of the 24th candle. How to interpret the probability of your entry bias based on these 6 bias formation dynamics of the third candle. 1. Bearish closing while opening bearish below the average price of the 24th candle. This is one of the 2 most accurate bias candles. When you see the third candle that opens below the average price of the 24th candle and closes below its opening price, it is a full-fledged bearish candle, because it opens bearish and closes bearish, and it means that your entry bias should be bearish on the opening of the 4th candle without delay. Your exit parameters should be 50 pips SL with 100 pips TP. This is one of the 2 times you should enter immediately the 4th candle opens, by entering on the closing bias of the 3rd candle. 2. Bullish closing while opening bullish above the average price of the 24th candle. This is the second situation where you should enter on the closing bias of the 3rd candle immediately the 4th candle opens. In this case you get a bullish closing bias in an accurate bullish signal of the 3rd candle, so you should enter to buy on the 4th candle with an exit parameter of 50 pips SL and 100 pips TP. In the first 2 cases above, the bias formed indicates that the market would trend for approximately 300 pips before the expiration time in the 24th candle reaches in only 20 minutes after entry. Your entry here is based on the belief that the candle's closing bias is a signal of the directional bias for trend price projection. If the market would not trend immediately, then it shouldn't have closed with this accuracy signal for trend bias formation. So in 2 of 3 cases, you could be right with your trend momentum price projection. So the first and second cases considered here signal the trend phase beginning or continuing, whereas the third and fourth cases that follow signal contraction phase. 3. Bullish opening with bearish closing below the average price of the 24th candle. Ideally you avoid trading in a contraction phase because there is no clear trend to be traded, and this is one of the 2 cases when a contraction phase is projected for the next 20 minutes or thereabout. When the third candle opens above the average price, it is classed called bullish opening, and when the same candle closes below its opening of price, it is called a bearish candle, but when it closes as a bearish candle below the average price, after opening above the average price, it is called a contraction bearish candle. When you see such candles, it means you should take a 20 minutes break and wait for the next phase to begin before you find your entry. 1 minute is too short for the market form a consolidation candle, so when this happens it means you don't have to trade in the phase entirely. This signals a strong consolidation phase beginning, and even if it doesn't consolidate at the end of the day, it's best to avoid any entry because there is no strong backing for your entry bias. Your entry bias cannot be bearish just because the third candle closed bearish, and neither can your entry bias be bullish just because the third candle opened bullish. Here there is a mix of both bullish and bearish signal because the opening is bullish but the closing is bearish. You can't follow the last command here, because the candles did not close in a proper way that shows respect for the support formed by the new average price. That lack of respect for the average price at the closing of this candle is what makes it a contraction candle, indicating a new consolidation phase to be avoided. In this third case, your entry bias is doubtful, and the principle of doubt in jurisprudence states that in doubt do not act. So, in contraction phase, your bias formation is filled with doubts, and for that reason you must not act in any entry bias. Avoid the contraction phase of the market for the next 20 minutes when a new phase will begin. This third case is similar to the fourth case that follows. 4. Bearish opening with bullish closing above the average price of the 24th candle. This is the fourth case of your entry candle bias formation. Here also, you're in doubt of your entry bias because the entry candle closed without any respect for the average price. First it opened bearish by opening below the average price, and next it closed bullish by closing above its opening price, but it didn't just close bullish, it closed bullish above the average price, and that signals consolidation phase because it closed as a contraction candle. A bullish contraction candle is a candle that fails to respect the resistance formed by the average price of the new market phase that began with the 24th candle of the previous phase that expired. When you see a bullish contraction candle, you can't buy just because the candle closed bullish and closed above the average price. 1 minute is too short for the candle to move in this way, opening below average price and closing above average price. Hence when this happens it is a strong signal for the beginning of a new consolidation phase. This phase is where no entry bias is backed by a strong reason. The market is neither bullish nor bearish, so the bias formed is doubtful. In doubt, you don't act. Wait for the phase to expire in the next 20 minutes, then reevaluate and enter if the next phase is clearly a trend phase as the first two cases considered earlier, or if it is an expansion phase as the last two cases that follow demonstrate. 5. Bearish opening with bullish closing below the average price of the 24th candle. This is one of two cases where the third candle helps you form an entry bias that recognizes the beginning of an expansion phase. In this fifth case, the candle opened below the average price, giving you a bearish signal at first, but then the candle closed bullish, also giving you a bullish signal. Now you have two signals in one candle. Which one would you follow? You can follow the two signals if you want to trade the expansion phase. First, you enter in the closing bias of the third candle. Immediately the fourth candle forms, and set a 100 pips TP with 50 pips SL. Then again, you enter on the opening bias of the third candle, once the market has moved 100 pips upward from the third candle's opening price upward, or once the market returns back to the average price and breaks it. Alternatively, you can trade only one bias, only the opening bias ignoring the closing bias. The two spots for entering will be first when the market has moved 100 pips above the opening price of the third candle, and closes with a bullish rejection of the upside after any 100 pips move. Then you enter on a bearish bias, and set a 100 pips TP and 50 pips SL. The second spot to enter is when the market completes the expansion move and returns to break the average price. You enter on a bearish bias below the average price and place your SL 50 pips and TP 100 pips. This is how to trade a mixed bias signal. Ideally, trade the both biases. If you're wrong on one, you could be right on the other. But if trading one bias, trade the two entry spots, one at the projected end of expansion and at the breaking of the average price. This is the case where the strongest bias is bearish based on the opening bias below the average price. The next case is similar to this case of expansion momentum price projection. 6. Bullish opening with bearish closing above the average price of the 24th candle. This is the second case of expansion momentum price projection. In this case, the strongest bias is the opening bias, and is bullish, so you can decide to wait for expansion to end downward. Then you enter a bullish entry at the end of expansion projected as 100 pips below the opening price of the third candle. You can buy on two spots, the first at the projected end of expansion and the second at the breaking of the average price. Both entries should have 50 pips SL and 100 pips TP. Remember that this is entry on market execution, whether trading one bias or trading two bias. If you trade two bias, you could lose one and gain one, or gain the two. If you gained the first one, then you can decide not to trade the second trade. If you chose to trade the second trade, you can either lose or gain in the second trade. You lose on the second trade if expansion extends below the 150 pips projection to trigger your 50 pips SL. You gain in the second entry if expansion ends as projected, your 100 pips TP is smashed. You can take the third entry when trading mixed biases, and you could either lose or gain the third entry. The third entry is to buy when the average price is broken, and you lose if your 50 pips SL is triggered, or you gain if your 100 pips TP is smashed. This is how to interpret the bias formation dynamics of the entry candle. Apply this to your trading and you will become more confident when trading Volatility 100 index. Want to see this in practical demonstration? Then join at CTFAQ on https://t.me/CTFAQ and to earn from referrals when building your own trading club. First, purchase your CTFAC membership on https://ctfac.bumper.shop. Welcome to a new trading path with your income guarantee from trading synthetic indices and building a trading club at CTFAQ.